It's a central bank marathon, and the markets are bracing for impact. Welcome to Macro Money. This is Ilya Spivak, head of global macro here at tastylive, and we have an action-packed week ahead of us. So what we're going to do here without very much delay is prepare and set the stage for what is going to be coming at us relatively quickly now as the world's policymakers grapple with an increasingly complicated set of variables in this next inning of the recession versus inflation Olympics. So first and foremost, let's get a sense for what is actually going on here. We can capture it in a relatively small handful of illustrations. The red line here, the 10-year break-even. This is an average across major economies, including the US, the UK, the Eurozone, Japan, and for good measure, Australia. And what we see here is that it tends to lead global CPI inflation by about 6 months. We've lagged that CPI here to show that those break-even rates, which are just the bond market's implied inflation expectations, when we take inflation-adjusted bonds, we take nominal ones, we take that difference, the residual in the difference between those yields is the inflation adjustment to get from nominal to inflation-adjusted or real. And so that gives us what the bond market actually expects inflation to trend like. You can see it anticipates actually reported numbers here by about 6 months. That should make sense. Markets are forward-looking, and of course, there's an inherent lag in actual data collection for official numbers. So what we see here then should be relatively sobering. Inflation expectations have seemingly stopped falling and haven't been falling for quite a while. So although we have a disinflation that's certainly there to be seen, we can see the orange line is declining. The expectation for where it will be going forward has stopped improving. This, of course, is a challenge for global policymakers that very much would like it to continue to improve because inflation in most major economies is still well above target. At the same time, the global economy appears to be starting to slow in a synchronized fashion. We saw that all through last year, and indeed through much of 2021, the story has been about synchronized slowdown. Manufacturing and services coming down, both as the catch-up growth from COVID reopening in the world's major economies started to peter out. Secondly, of course, as a very pointed, very energetic rate hike cycle led by the Fed started to grind down global growth. We saw toward the end of last year, right around October, November, December, just as stock markets appeared to bottom after a near year of rising rates driving them lower, a significant divergence between services and manufacturing. And the story on global growth looking relatively rosier because, of course, most growth in major economies is driven by services. And so what we ended up seeing was this dramatic divergence whereby service sector performance veered toward the upside, largely thanks to a consumer in major markets that ended up looking resilient relative to what was going on global goods markets, where demand started to ease thanks not only to the shifting of spending during the pandemic. Of course, people mainly spent on goods because they were in lockdown. They weren't going to restaurants. They were not going to concerts. They were not going to art galleries. They were not taking a trip or traveling someplace for work or for pleasure, for that matter. And so we had a kind of shift in the spending structure in favor of goods. As we got into the back half of last year, there seemed to be this divergence where, with increased reopening, more and more of that spending was diverted as a sort of catch-up in the services direction, at the same time that global central banks' actions on rates were really starting to crimp international commerce. And so we have a sort of wedge through much of the first half of this year that opened up that now appears to be starting to close. We can see some coordinated slowdown now over the past 1 to 2 months in global manufacturing and services, starting to bring down the overall composite growth rate. This showed up in spades in PMI data released here at the start of this week, the last week of July, as we see disappointing numbers out of major economies across sectors, starting to suggest that perhaps that wedge is getting ready to close, and those realignments in spending, that catch-up on the service side, has run its course. So just as we get this sense that the global economy is losing traction on disinflation, we get the sense that maybe there is a slowing that is spreading across more of the global economy, and a darkening of the business cycle that is more coordinated. This, of course, makes for a very challenging situation for global central banks, which on the one hand want to keep the pressure on the inflation side to keep it coming down, but on the other hand, see a vulnerability in over-tightening as we get this downturn. And it's with this in mind that 3 of the world's leading central banks will get an opportunity to opine as to how they envision reconciling the way forward. We begin, of course, with the Fed. The likelihood that the Fed was going to raise rates at this upcoming policy meeting this week really hasn't been questioned for the better part of a month. Expectations have veered between just north of 80 to now a commanding 97%. But at no point did the market really seem to question very much the likelihood that the Fed was going to make a move on rates at this meeting after a pause in June. The larger question seems to be what's going to happen thereafter. As we can see here, there's about a 40% chance that we could get a further hike in November. If we look at the number of hikes cuts column there, we can see it's 1.4 for November. So one hike baked in, 40% of another one also there in the outlook. We can see that then begins to fade. And as we look deeper now into next year, we can see that around March is where the tide starts to turn, and come May, we will have given away the hike that we're just seeing here now. So if we look at the implied rate structure here, we can see that we're expecting to be north of 5.25 as of this meeting. So the implied rate for July, 5.32. We get as high as 5.43 in November, so that's that 40% chance of a further hike that would have taken us north of 5.5. And come May, we're back to 5. So we will have given away by then, ostensibly, the hike that we're just about to see right now. From there, we get a significantly energetic easing cycle. We can see that there's a cut fully baked in by the time we get to July, and almost a fully other one already in the outlook. 62% chance of 2 cuts by then. Those 2 cuts are fully there by September, 3 cuts there by November, and a very commanding probability, 79% of 4 cuts by December. So we essentially retreat back to about 4% by the end of next year. That's the baseline forecast going into this Fed outlook. We can see it in spades here that the main moving part has really been what happens after July. So if we look at the July curve, that's that blue line there, you can see it's been mainly at a standstill since the middle of May. It's moved around a little bit, but very, very little. So where rates are going to be about 5.25 to 5.5 range, this policy announcement, that seems to be very well baked in. Then we can see that the red line, which is the December implied rate in Fed funds futures, that's been more active. The gray bars are the spread between the two to give us a sense for how much of a move the markets expect to happen between this meeting and year end. And you can see they're flirting with a slight tightening bias here, but it's not quite a full hike. This would be a full hike, the 25 basis points here, and you can see we're pointedly underneath that. This then becomes the main vector by which volatility might be created in this outlook. If the Fed comes out more hawkish than that suggests, we're likely to get a response from markets. Now, why might that be? We still have an issue for the Fed that is primarily service sector oriented. The market made a whole lot of June's very soft CPI number. It undershot expectations to register at 3%. And that was, of course, a source of much optimism around markets. Stocks went up, yields came in, dollar fell, gold rose, all of it as if to say, okay, the Fed's done here after the July meeting. Everybody is convinced that July is going to happen, but after that, this tightening cycle is essentially over. And there's going to be a period of holding, as we've just seen, and then March, May of 2024, a pointed, aggressive easing cycle kicks off. Well, that's all interesting, but the problem there becomes that June, as we can see on this chart of CPI here, was also the year-on-year comparison with the absolute peak in inflation north of 9% last year. So you can see there, the absolute peak was June 2022. So when we compared that this year, after the kind of disinflation we've already seen, from 9 down before the June number to about 4 and change, so more than half of inflation already squeezed out, that was always going to be a tough year-on-year comparison. We were going to compare numbers that had been falling for months with the absolute peak in where they were rising in the inflationary run-up. And so we now are going to have a much more difficult time engineering year-on-year CPI declines at this magnitude, because, of course, now we're going to be comparing against numbers that are already falling. Not only that, but we can see that the main way that we have inflation linger in the service sector, the imbalance of supply and demand in the labor market. Service sector, of course, employs close to 80% of American labor. We can see here that there's still a very substantial mismatch of nearly 5 million jobs, whereby supply undershoots demand. And so, in so much as the Fed's problem really hasn't changed in this sense, and base effects will make inflation more difficult to come down at headline levels going forward, we may have a Fed that has reasoning to come out at this meeting and signal to markets that they are underappreciating the extent to which they are prepared to go again, or at the very least, underappreciating just how soon an easing cycle can begin. In fact, if we look at inflation expectations relative to what inflation itself has been doing, we can see there's about a 2-month lag here between the short-term break-even rate, the 2-year, and the 1-year U.S. dollar-based inflation swap. These are 1- and 2-year inflation expectations. That lag would suggest that inflation is going to start to have perhaps a hard time continuing to decline from here. Those expectations have been moving sideways. This is the opposite of what the Fed wants to see. It would like to see continued progress. And perhaps what they see in the markets having stopped pricing out disinflation at the same clip that they have been is a reason, at least rhetorically, to push back. And so if we then, out of this, get a more hawkish Fed that comes out and says, we're not looking at cuts next year, that's not our base case scenario. We are, of course, data dependent and prepared to do what needs to get done. But we still see inflation as the bigger issue. We're still prepared to sacrifice a degree of growth to keep it going lower. And we don't have any intention to have a rapid rate cut cycle starting sometime in the second half of next year, or perhaps as soon as the back end of the first half. That's not what we're aiming at. If that's the message that we get, the response could well echo what we saw toward the end of last week: a stronger dollar, stronger yields, weaker gold, weaker stocks. After the Fed, the focus shifts to the ECB. Here we are also looking at an overwhelming likelihood of a rate hike, 97% almost fully baked in probability that we're going to get another increase. And indeed, the ECB all but pre-announced it. In fact, that's been what the ECB has been doing recently, is coming out at policy announcements, delivering a 25 basis point increase, and then saying, unless something truly remarkable changes to alter the course of things as we see them, we're going to go again at the next meeting. As if to really make the point clear for financial markets that their inflation fighting mettle is very much intact, that policymakers are unbowed by forces outside of the inflation fight, and will continue to press that point until disinflation is had in earnest. In fact, we can see the markets currently are pricing in about a 70% chance, 71% chance of a further hike beyond this one by September. In October, this calculus is already looking like we are going to almost certainly have that hike. And so looking at this going forward, we seem to be in a situation where the risk for the ECB is that they might have to go the other way, or at least perhaps not pre-announce it this time. Now, looking at how inflation expectations are developing in the euro area, it's more dire even than the US. Whereas in the US, as we just saw, inflation expectations appeared to have stalled. Here, they're pointedly going in the wrong direction. So looking at the five-year inflation swap here, looking at Germany's 10-year break-even, we can see inflation expectations aren't just not declining, they're actually rising. And they're looking to be north of the ECB's 2% target over a longer term. That's even as headline CPI pulls back here. You can see the latest number there, 5.5%. So perhaps what this means for the ECB, though of course they are almost certainly going to try to put on a brave face, they're still very much off sides as far as the inflation target. 5.5% is quite a ways away from 2%. And with inflation expectations trending in the wrong direction, they certainly don't have the luxury of letting up, at least openly. We nevertheless have a dire economic situation. The rollover that we saw on global PMIs has been happening for quite a bit longer here, where we can see that unexpectedly, in numbers released just overnight here, the Eurozone economy is now in contraction. The composite index has dropped back under the 50 line. That's the sort of boom-bust level in PMI logic. Under 50 is contraction. Above 50 is expansion. The further you go under 50, the faster the contraction. The further you go above, of course, the faster the expansion. And what we see here is that services is aggressively slowing in July. Manufacturing has continued to look abysmal and is, in fact, contracting at an ever-accelerated speed. And so now the economy itself seems to have shrunk in July for the first time since late last year. What's more, if we look at the way that economic data has been performing relative to forecasts, it has been in near free fall. So economists seem to have their rosier expectations of what the Eurozone economy might do increasingly disappoint relative to realized results. So what we end up with then is a situation where, on the one hand, the ECB needs to deal with these inflation expectations going in the wrong direction, but on the other hand, the economy appears to be withering. And so perhaps the way that this is reconciled is, as we alluded to moments ago, maybe what they don't do is pre-announce this time. And while that's likely to give a knockback to the euro, it may also have broader global implications because, of course, the Eurozone economy taken collectively is also the world's largest. Certainly not singularly so. The U.S. is still the largest one-country economy. But the Eurozone taken collectively as a single market is larger still. And so what we end up with then is a very worrying sort of story for global growth at large, especially if the ECB ratifies this slowdown with action by backing off a little. And that might be bad news for stocks. That might be bad news for risk-geared assets in general, cyclical assets, the likes of crude oil, copper, perhaps even related currencies like the Australian dollar that might decline in sympathy with the euro if there is a broader signal here for the global business cycle. And finally, Japan. Here, too, we are going to get a policy announcement. Expectations are that we are not going to get meaningful movement on rates. You can see it here in the implied curve. In a month's time, rates expected to move all of 2 basis points out of deeper negative territory to perhaps slightly less negative. And not until a year from now do we envision that there's going to be a meaningful move out of that negative territory. Not for 2 years do we approach anything that looks like a standard-sized rate hike. So nothing seemingly moving fast here for Japan. Now, markets have flirted with the idea that maybe there is a bit of a sea change that's afoot. We do have some of those ingredients in place. The markets have been enthused about Japanese inflation registering north of 3% for a couple months in a row. That's quite a bit more than the target 2%. And of course, there's a new BOJ governor at the helm, and he's not quite like his predecessors, whereas they had generally a history in Japanese government, the Ministry of Finance, perhaps, a career at the BOJ, institutionally over a long period of time. He comes from academia. Not only that, he comes from the stable of economists groomed by visionary macroeconomist Stanley Fischer. The BOJ governor currently, Kazuo Ueda, then is in the ranks of economists inspired by Mr. Fischer that include the likes of Ben Bernanke, Mario Draghi, Greg Mankiw. Certainly Bernanke and Draghi come to mind, of course, front and center. A former chair of the Fed and the former president of the ECB there, with a penchant for creative monetary policy making during and immediately after the 2008 crisis, the Great Recession. And so the markets seem to be looking at Ueda saying, well, maybe he too has a penchant for creativity. And maybe these higher inflation numbers mean that there's a sea change afoot for the Bank of Japan. And they've run with that speculation to some extent. But that much seems unlikely. If we take a look at the makeup of Japanese inflation here, it seems to be mostly imported, considering the largest contribution appears to be food. So energy now a disinflationary factor. Goods and services, not really a major contributor, it would seem. They've been squeezed out to a large extent, as has been housing. The biggest wedge appears to be food, and that appears to be reflective of the global rise in soft commodities, which have veered from overall commodities to a meaningful extent. But even that mismatch seems to be closing. Much of that story owed to spiking sugar prices, and the issue there, which was an export cap out of India, seems like it's already being offset by a bumper crop in Brazil. So it seems to be that perhaps there is no reason to act here for the Bank of Japan because they do not have the kind of inflation that they would need to fight with domestic tools because it is taking root in domestic factors. What's more, the pressure on Japan's yield curve control element of its monetary policy, where we, of course, saw reactivity in spades at the beginning of the year, appears to have eased. This is a policy where at the beginning of this year, there was concern because what the Bank of Japan was saying was, we're going to keep a cap on the 10-year JGB yield, Japanese government bond yield, that's the red line you see there, of 0%. And we're going to have an allowance of up to 25 basis points in each direction that we're going to let this thing swing around 0. And that's as much as we're going to let it move. Well, as you can see here at the start of last year, that gap between where they were letting it be capped and where the market thought it should go, as implied in the overnight index swap market, started to widen. That gap, these gray bars here. Once that gap crossed over beyond 25 basis points, it started to violate the bounds of Japanese monetary policy. It required the extending of the leeway here up to 50 basis points, which of course saw the yen surge higher. But the pressure appears to have been relieved. We can see the gap has now closed to below 25 basis points. Not only the current allowance of 50, but the prior one. So the pressure on the Bank of Japan here to really do anything on policy seems to not appear acute. And so the Bank of Japan probably doesn't do much of anything. To that extent, they might give a little bit of a respite for global financial markets in that a Bank of Japan that doesn't raise rates, that doesn't adjust yield curve control to a less dovish setting, is telling markets that there will continue to be cheap yen-denominated financing for some time yet. And at a time when other central banks are aggressively tightening, this is a bit of a salve for markets. Cheap credit is at least still available somewhere. And so if we get any kind of battering from the Fed and the ECB leading up into the BOJ's announcement, perhaps this calms investors' nerves to some extent. It is also, of course, likely to fare poorly for the yen, which might decline in response. And that is the central bank marathon directly in front of us. It comes to us on back-to-back days, Wednesday, Thursday, Friday. We'll keep digging into it as the week progresses and as the markets set themselves up and prepare for what the response is likely to be. Macro Money is here every day, Monday through Thursday, right after overtime with Chris Vecchio and myself, where we break down what happened in markets on a given day and try to make sense of it within the broader narrative. I'm also on with Chris for Futures Power Hour on Friday, on with Tom and Tony for First Call on Sunday evenings, writing for the News and Insights section of tastylive.com. In fact, these very things that we've just discussed here, there's an article there explaining them in written form and trying to make some of these same points. So if there's anything that was unclear here, that can be a sort of companion explanation. And of course, opining outside of all of that on Twitter at Ilya Spivak. Thanks very much for joining, everybody. Happy trading this week. See you tomorrow.